The U.S. dollar continues to lose steam as investors pour money into currencies that have been beaten down in recent months, like the euro. All right, let's take a look at the U.S. dollar index. There you see quite a decline over the past few days. So what does this mean for investors and the Federal Reserve? I want to bring in Brian Rehling, the co-head of Global Fixed Income Strategy at Wells Fargo Investment Institute. And Brian, what do you make of the dollar's retreat here?
We think this is a temporary sell-off in what is still longer-term dollar strength. So we're not saying the sell-off is over. We could see some further weakness in the weeks ahead, but we think that longer-term we're going to see that strength in the dollar return.
All right, but what if that doesn't happen? Then what? What does that mean for the economy if that rebound never, comes to fruition?
Well, that would be a bit of a surprise. It would likely mean here that the U.S. Is growing at a weaker pace than what we're seeing globally, and starting to see some of those global economies start to pick up a little bit of steam. That's not what we expect, but that would likely be what such a more sustained weakness in the dollar would mean.
But could this softness in the dollar, at least right now, be helpful for companies, especially as we look ahead towards the second and third quarter earnings season?
Well, it's possible for sure, although we're finding a lot of the large multinational companies are doing a lot of hedging of currencies these days with the added volatility. So in many cases, it's likely to be offset by some of the hedging activities.
All right, and how will the Federal Reserve factor in the dollar's decline? Does it give them more of an opening to hike interest rates?
Well, if it remains sustained, I would say yes, it gives the Fed a little bit more of an opening. Clearly, the stronger dollar was doing some of the monetary tightening for the Fed, almost de facto tightening. So you're right, a sustained weakness would give the Fed an opening or more of an opening. But again, I think we need to see this persist for a couple of months at least longer before the Fed can rely on the dollar weakness as more of a sustained trend.
And when you say this is a short-term weakness, define that. What do you mean by that?
Well, we've been seeing the weakness now for, 4-6 weeks or so. Could we see it for another 4 weeks? Yes, that would be short-term. So short-term, 3 months or so, we still think that does not change the longer-term trend, at least cyclically, which is that kind of an 8-year trend. We're about 4 years through it of dollar strength.
Yeah, and it seems like a June rate hike for the Federal Reserve is off the table. But when do you think they'll tighten? Is September still in play or something maybe even later?
Yeah, obviously I think June and late July completely off the table for the Fed at this point. I do think the likelihood, 60-70% likelihood, is that we will see the first rate increase in September. Not that the Fed necessarily needs to do it. The data doesn't necessarily support that at this point. However, it's very clear that the Fed wants to get started, and they've conditioned the market. So I do look at September as the most likely.
Yeah.
But, we could see that pushed back. That's much more likely than seeing it pulled forward.
All right, Brian, thanks very much for joining us.
Thank you for having me.
I'm Scott Gamm, and you're watching The Street.